Well, thank you all for joining. This will be the absolute best panel of the day, I am sure. And I know with my panelists here, we hope at some point these Zoom conferences will end and we'll be back in person at our favorite IMN locations. So let me start. Ed Stefflin, Senior Vice President at George Smith Partners, a capital advisory firm, as well as co-founder of the Balcar Group, which is a build-to-rent company that we've got 3 different developments going on. George Smith Partners has been very active in the single family for rent space. We're based in LA, I'm based in New York, been active in Arizona, Texas, Carolinas, Florida. We advise on all types of real estate, and in particular, just single family rental, given my Balcar Group investment, which started in 2018. My partner, Paul Davey, has been a natural extension of that. So with that, let me have my panelists start by introducing themselves and their firm.
Hi, everyone. My name is Boris Robel, Managing Director at CoreVest Finance. CoreVest is one of the leading single-family rental lenders in the United States. We focus both on kind of scattered site SFR financing, but also built-for-rent construction and bridge financing as well. And that's really what I focus on at CoreVest. We've closed probably $500 million or more of built-for-rent construction loans, like really all around the U.S.
All right, so Boris, let's put you on the spot. Let's talk about a recent deal you worked on and the actual terms.
Sure. I mean, so we've done a whole number of just kind of static single project, construction loans. This loan is actually kind of in the process of closing, but I thought it'd be kind of interesting to mention it. And I'm hoping to close it in the next 3 weeks or so. So we actually structured this particular construction loan as a revolver. It's a pretty large project down in Tampa. It's like total is about 720 units. We're doing like the first phase of 360, and we broke it up into 6 sub-phases because ultimately the sponsor wants to either refinance or sell in phases. And so it's kind of interesting in that, while we set a revolver cap for these things and then, measure a 75% LTC off of that revolver cap. But that's below the actual total financing. You actually end up with like a little bit over 80% loan to cost in the entire financing, which is pretty accretive for the sponsor in this particular project. But again, you're only going to really structure these revolvers on bigger projects because there's a little bit of modeling complexity and loan structuring complexity that's involved. And that's at LIBOR 600 with a 50 bip floor, 1.5 origination fee. It's non-recourse loan with a completion guarantee. On the completion guarantee, the sponsor here is capitalizing an entity to serve as the completion guarantor. And he's a really experienced builder. Felt comfortable with him doing that. And so then that's kind of a pretty interesting one again, just because of the way we've structured it.
Yeah.
And I'm also working on a couple of Sharia compliant loans, which is also I could kind of go into if everybody wants.
Okay. Well, first a couple questions here. 720 units. Is it all in one site, or is it?
Yep, it's one site. It's the biggest.
20 build to rent.
Yep, it's the biggest project I've seen. Right, usually you're kind of land constrained on these projects, and so they tend to be kind of between 100 and 250 units. This is like a massive. It's like a 70-acre land parcel.
Wow, impressive.
Yep.
So why don't we turn it over to the rest of the panelists here and talk about how do you compete on term business, at mid 3s or lower, how do you guys compete there?
Yeah, I mean, and that's kind of where, where we, and I think I'm sure some of my fellow panelists here compete with these is on the scattered site BFR. We have a number of clients who build just scattered site, kind of onesie twosies, maybe 10, 15 homes in kind of different, parts of town, and then aggregate them into a portfolio. And then we would term that out for them. So, the agencies again haven't really dipped their toe in those particular waters. So we can be competitive there. Also, a lot of folks don't want to wait for that 90 for 90 stabilization period. Some guys want to buy down their rate a little bit earlier. And so we've done a few deals on some single tax lot, like BFR projects where sponsors didn't want to wait for 90 for 90. They wanted to, cash out a little bit, repay some of their investors. And we've structured some some flex prepay for them to kind of get them over the hump, and ended up doing a loan, albeit at a slightly higher interest rate than what the agencies offer, but it met the developers' other needs.
Okay. Let's talk about what's happening in the space with the number of entrants. And I think, you know, when everybody gets their $1,400 stimulus, we'll have that many more people entering the BTR segment, you know, which is super popular. So let's talk about, you know, we talk about the easy, we talk about terms, but what are the challenges of getting deals done?
Yeah, I mean, I would agree, Steve, with a lot of what you said. Oh, actually, all of what you said. You know, so the couple things. One is, as you know, as we're seeing kind of more, you know, an institutionalization of the kind of PFR space, we are seeing, you know, a lot of institutional LPs coming in, and it is a constant battle of control rights. But also, you know, we take a look at, can this partnership weather, you know, a liquidity crunch, right? What do their overcall provisions look like in the operating agreement? That's incredibly important, because ultimately, as you look at the guarantor and you look at their liquidity, obviously, it's not going to match what the big institutional fund can have at their disposal. But is that fund actually required to put any money into the deal, right? To kind of, you know, or else you'll have some hyper dilution come into play. The other challenge has been that, you know, while a lot of kind of my colleagues here, we talk about, like, you know, highest leverage humanly possible. When you have institutional players coming in, institutional LPs, their funds are capped at how much leverage they would allow themselves to be subject to, but also their developer partners. So actually, you know, in response to that, we launched a 65% LTC non-recourse program for built-for-rent projects, because we found that more and more of our, you know, developer clients had institutional partners that they want 75%. Like, they were capped, they couldn't do it. So now we're starting to offer, like, lower leverage non-recourse financing to try to solve for that.
Yeah, I know we've talked about that, Boris. You know, it's weird when we had to push back and say, well, the developer actually doesn't want 75%. You know, in real estate, that's very hard for the developer to push back against leverage, because it's the nature of the beast. But a lot of the institutional clients want to have a bigger equity check and don't want expensive debt in front of them. And so Boris and I had a number of those conversations where we really needed a cheaper 65% LTC product. And he came up with one. So nice work. So let's go to, we've got a couple questions here from the audience as well, and one that ties with one of ours, which is certificate of occupancy deals, right? In terms of, are we funding certificate of occupancy deals, which, for everybody's benefit, these are deals where you have a committed buyer, puts down a deposit, the developer builder, you know, basically delivers the homes at C of O, and that's the end of it. The new buyer takes over. Have you guys focused on any of that?
Yeah, I mean, I look at a lot of those types of transactions. Again, there's some instances like the one that Keith Merrill, where Keith mentioned, where, you know, it's just really cheap, cheap financing, especially at the lower leverage points. I'm working on a series of 5 right now, and those are in a Sharia compliance structure, which, you know, I think is a lot of my colleagues here. Keaton is nodding his head, right? Those introduce, you know, a whole host of complexity to the situation, but, you know, not a lot of other folks are doing that, and so we're very fortunate to have some good credit people and some good attorneys to structure and kind of get comfortable with the Sharia compliant nature of these. But, you know, the key I think for, like, a lot of my colleagues is, if you can, the certificate of occupancy deals tend to be very short term, right? These homes are delivered, you know, in a period of a year. If you can structure your deal with no lockout, or very kind of maybe a small make whole, if any, that there's some, you know, really good business to be had out there. Yeah, I mean, it's very difficult to overbuild build for rent, because it's such a land intensive product. Right? You can have a, you know, let's say a 20-acre site, you can throw up 400 multifamily units, no problem, right? You can't do the same thing with build for rent, right? That's you're delivering, you know, 1/3 of the units, the same land, and there's only, you know, so much availability of well located developable land. So I think, you know, the runway here is incredibly long, and the lease up time will continue to shrink, even though there's some additional supply coming down the pipe.
Okay. I want to come back to a couple things here in a minute, but I want to get a couple audience questions. So one of which is, do any of you finance modular, or have you, you know, arranged financing for modular build to rent? So, you know, modular homes.
I can take that one. So we've done like 5 modular build for rent construction projects. 2 in Huntsville, 1 in Nashville, 2 in Florida. So those are a little bit more complex, right? because you have to figure out a way to finance the offsites. We've actually successfully done that by essentially incorporating like a line of credit into the loan that allows for the progress payments to the factory prior to the homes coming on site. And then we just essentially, once the homes get affixed, the foundations, we end up reimbursing that working capital account and then kind of going, just kind of spinning around a few times and settle up at the end. The key is there's a difference between modular and manufactured. And so the key for us is that it is a true modular home. It meets both HUD as well as local zoning guidelines, receives like a local certificate of occupancy versus like a manufactured home. Even though it might be a fixed foundation, it still is only like built to HUD specs versus local specs as well. So that's kind of a sticking point for us.
And so when you get the, people say non-recourse, but then sometimes people read the print, you get the completion guaranteed, bad boy, environmental indemnity. What kind of, so say you're doing a $20 million loan, what kind of net worth liquidity are you looking for from that guarantor? Or,
Sure.
Just some concept of how that guarantor needs to look.
I mean, we're looking at something and we kind of start off at 100% net worth, 10% liquidity. And then we work from there. Some folks don't have that. As the project gets bigger, it's very difficult to expect someone to keep, 3, 4, $5 million of cash around. So certainly if someone's net worth and liquidity don't quite meet our requirements, but their track record, background, and experience do, we pad the interest holdback, right? We'll pad the contingency a little bit more, make sure that there's the good GC in place with the GMP that we can really rely on, and that certainly helps us get some exceptions to the net worth and liquidity requirement tests.
Where do you all, this is going to go around the horn, where do you think cap rates are today? I know it probably varies a little bit, but if you were to say the average SFR cap rate, if you were to sell, a fully leased project, Boris, what do you say?
Sure. I mean, Phoenix and Austin aside, those are kind of separate. Those are distinct animals right now. Seeing cap rates around like 5.25. Certainly, there's parity between multifamily and built for rent. Those cap rates have converged at this point.
Yeah, and I think one of the things I've seen with valuations and appraisers is tax rates, right? So some jurisdictions don't really know how they're going to tax these projects. And so I think that's been a big variation. And then obviously the COVID penalty that some appraisers have put in, but I think now we're coming back around to more normal. We're going to be winding down here in a few, but I'd love to get everybody's thoughts on supply. Do you worry about it? Certain markets, just some thoughts there. Boris?
Yeah, again, as I mentioned earlier, it's a very land-intensive business, and as a result, it will be challenging to overbuild. Again, just due to the density. So I think there's certainly, consumer preferences have changed. The current multifamily stock is just not really equipped to deal with consumer demands, having only 9% or so, or 11%, having 3 bedrooms or more. I think it'd be very difficult to overbuild in the sector for the foreseeable future. So I'm not concerned about supply at this point.
But one of the things, I do worry a little bit about supply, and I have 2 build-to-rent deals in Tampa, and then Boris throws out he's doing 720 units. So you kind of, you get concerned. But I agree with you. I think there's a big movement here, and I don't know if you saw John Byrne's opening remarks, but I think there's a whole class of people who would are you going to skip buying that first starter home and just move into rentals? So I think that's coming. Last question here is, do we have any deals that have gone bad? Loan budgets, construction problems, anything you've had to work out?
Certainly, we've had quite a number of loans over the past year or so where they've had construction delays because of COVID, right? I think that's common across everyone here, right? And so we've had to do some extensions for sure, right? Just to accommodate that. The sponsor, they didn't do anything wrong, right? They couldn't get people to work for a certain period of time. Then the counties got overwhelmed. They couldn't get their COs on time because there were just so many CO requests. So we've definitely had to be flexible with some folks over the last 12 months.
I don't know. I mean, they couldn't predict a global pandemic. I mean, come on.
Yeah, right? Like,
Who can predict that? But have you guys financed extra budget? I mean, have you had to come out of pocket and work with your borrowers for that extra lumber, for rebar? I don't know, whatever else has been going up.
so we structure our loans like a 7.5% hard cost contingency. And so, they've been able to, that's been, for the most part, it's been sufficient. The other thing is we've noticed that lease up was substantially faster than we thought, at rents that are higher than we had underwritten. And so we had a little bit of cash left over in the interest holdbacks that we could reallocate to hard cost contingency or perhaps some other cost overruns. Again, if we were doing this in the state of New York, this would never be possible. But certainly in other parts of the country where the lien law is a little different, we were able to kind of shift some things around to keep projects on track and kind of minimize burden on our clients who obviously had very good intentions and were good actors throughout the process.
Okay. Well, I want to thank you all. We're about at our end here. I know that, people in the audience can reach out to us either through the IMN Connect, through LinkedIn. We'd all love to hear from you. And with that, Pete, I think I'm supposed to turn it back over to you.
That's right. Thanks very much, Ed. So I'd like to thank Ed and Keaton, Steve, Matt, Nate, and Boris for the work they put into this and for sharing with us their time and their expertise today. I thought that was a really interesting discussion, and I'm sure the audience will agree with me.
CoreVest is the leading lender to residential real estate investors. For more information about our long-term rental loans or short-term bridge loans, visit CoreVestFinance.com.